Tom, the stock-bond correlation is super hard to understand and predict, but financial advisors everywhere just use a negative return correlation assumption. And to me, that's wrong. The 12-month correlation historically between stocks and bonds has flipped signs 29 times over the last 80 years, from positive to negative. It has ranged from minus 80 to plus 80. Now, the key to understanding the correlation is a simple question. Are we facing a growth shock or an inflation shock? If you're facing a little bit of both, it's complicated. But if inflation volatility dominates, both stocks and bonds can go down together. We learned this in 2022. And by the way, if you're a nerd like me and you studied correlations back to the 70s, same thing that happened in the 70s.
Yeah.
I do think, looking out 6 to 12 months, that inflation volatility is going to dominate. So I'm arguing you should diversify your hedges, not just use treasuries.
Cliff Asness alludes to the idea that we have equity products and we have equity exposure, even though we're not calling it equity. All the alternative and derivative products out there today, Paul's better at this, folks, than I am. All those private this, private that, are those equity equivalents?
Look, I think they are in a broad sense. We're talking about businesses. You value them by discounting cash flows. You use an interest rate to discount the cash flows. Tom, it's CFA stuff, right? And then their discount rate should be influenced by risk and liquidity and market conditions. But, you know, Cliff Asness likes to be controversial, and he calls it volatility laundering, I think is the term he uses. But we don't mark to market the private assets. Look, private assets can be wonderful additions to investors' portfolios. In my own personal portfolio, I own private assets. But
that's the Montreal Canadiens, but
shove,
continue, you know. That's his private asset.
Yeah.
It's a Montreal.
But, you know, those are financial assets. And if you're kind of a mark-to-market person, I think it's better to build risk models around an assumption and adjustments where you can, you know, synthetically mark-to-market those investments and do a more thoughtful portfolio construction. Well, these are great assets generally. They're just not free lunches.
So, Sébastien, what are we doing in the bond market here? How much credit risk should you be taking in a world that has black swan events, has a lot of cross currents, has a lot of geopolitical risk here? How about credit?
We're slightly long credit. And yesterday was interesting because the relief rally was clearly risk on. You saw high yield spreads tighten again. To Tom's point, the VIX went down. You had 5% pops in stock prices. Also, it was favorable to the broadening. You know, European stocks did well, emerging market stocks, small caps, they all outperformed. But I think we also need to accept that there's remaining inflation pressures. Damage has been done. And, you know, oil prices yesterday, they went down 20%, but they stabilized 50% higher than they were 12 months ago. Yep. So we don't expect a recession. The underlying forces in the economy are actually pretty good because, you know, the Bloomberg's Economic Surprise Index is at its highest in 2.5 years. And someone just showed me data that the tax refunds are running 14% higher than last year. So quietly in the background of all these headlines, the economy's humming, if not accelerating. So we don't expect a recession. We're short duration because we're worried about inflation risk, but we're slightly long credit.
What do you expect, Sébastien, this Federal Reserve to do? It looks, if I'm just looking at the WIRP function on the Bloomberg terminal, I got nothing. I mean, the market's not looking for cuts, not looking for hikes. It looks like they're just going to sit on their hands here.
I think nothing is the base case, but if you ask me where's the skew, to use a technical term, right? Can you get, is the probability of an upside surprise in inflation greater than the probability of a downside surprise? I'll give you a resounding yes. You know, just look at where oil prices is stabilizing on a day like yesterday when we think the strait is going to reopen. It's nowhere near where it was. And go ahead, Tom.
Well, we got to go. Keith Lerner's here going, when am I on? Sébastien, as simple as I can, have you attended the Orioles yet? Have you sat in the Rowe Price box? It's in the dugout.
Oh, yeah.
And have you seen Alonso play yet for the Orioles?
I haven't. I can't wait to go. Players are wearing a T. Rowe Price patch. We have T. Rowe Price signage at the stadium. It's a wonderful partnership between the Orioles and T. Rowe Price, where we have our global headquarters. So, and Tom, my dream is to watch a game with you one day.
Well, we'd like to do that. I'd love to see I saw the Canadians the other day in New Jersey, Sébastien. I would kill to see Les Habitants with Sébastien Page, always of Quebec